What does it mean to invest safely in today's ever-changing world? Imagine putting your hard-earned money into an investment only to watch it vanish overnight. It's a nightmare that keeps many people from stepping into the world of investing. But what if I told you that safe investing doesn't have to mean missing out on growth? The year 2026 is presenting us with a unique set of challenges and opportunities. You might be wondering, how can I invest safely while still making a solid return? Well, the truth is, there is no one-size-fits-all answer. Safe investing isn't just about avoiding risk, it's about managing it. In fact, risk is inherent in any investment, but it's how we navigate it that matters. Let's start by discussing what safe investing means in 2026 and why it's crucial to adapt. In the past, safety meant bonds or low-risk assets, but times have changed. Today, the landscape of safe investments is much broader and more dynamic. Technology, inflation, and global markets are reshaping how we think about risk. So the first step to investing safely in 2026 is understanding the landscape. A good place to start is by diversifying your portfolio. Diversification is like spreading your eggs across multiple baskets. By doing so, you reduce the risk of one failure, wiping out your entire investment. But how do you diversify? The key is to mix different asset classes. Stocks, bonds, real estate, and alternative investments should all be considered. But diversification alone isn't enough. You need to think about what's driving the market today. One of the biggest factors to watch in 2026 is the impact of inflation. Inflation erodes purchasing power, making it more difficult to achieve financial goals. But not all investments react to inflation in the same way. Some, like real estate and certain stocks, can actually thrive in an inflationary environment. Other assets, like cash and bonds, may lose value as inflation rises. So in 2026, it's essential to look for investments that can weather inflation. But here's the twist. Interest rates are also a key player. Central banks around the world are adjusting interest rates to combat inflation. Higher interest rates can make borrowing more expensive, but they also impact the stock market. It's a delicate balance. The right interest rates can create opportunities, but the wrong ones can trigger losses. For safe investing, focus on sectors that perform well in higher rate environments. For example, financial institutions and dividend-paying stocks often thrive when rates go up. Now, let's talk about one of the safest investments you can make: yourself. Investing in your own knowledge and skills is often overlooked, but incredibly important. The more you learn, the better equipped you'll be to make sound investment decisions. Education empowers you to identify risk and spot opportunities that others might miss. Another critical aspect of safe investing is patience. The world of investing can be volatile, and many people panic when markets dip, but a long-term perspective is often the safest strategy. When you focus on your goals and avoid knee-jerk reactions to market movements, you reduce risk. So what's the secret to investing safely in 2026? It's a combination of knowledge, patience, and strategic diversification. But there's one final piece of the puzzle: being adaptable. The financial landscape is constantly shifting, and the ability to adapt is key to long-term success. Whether it's changes in technology or unexpected global events, flexibility will protect your portfolio. The investments that seem safe in 2025 might not hold the same appeal in 2026. Staying informed and being open to new opportunities is a hallmark of a successful investor. By now, you may be feeling more confident in your ability to navigate the world of safe investing, but let's dive deeper into specific strategies for safe investment in the next section. In the following parts, we'll break down some of the most promising and secure options for 2026. We'll also explore how to balance risk and reward without jeopardizing your financial security. But first, it's important to understand the mindset of a safe investor. Are you ready to take control of your financial future? Because in 2026, the best investors won't just wait for opportunities, they will create them. Safe investing isn't about avoiding risk, it's about managing it in a way that works for you. You can protect your wealth and still grow your assets if you know how. As we explore safe investing strategies, remember that it's not about perfection but progress. The goal is to feel confident in your decisions and secure in your financial future. So let's take the next step together and explore the specific strategies that will help you succeed. In part one, we discussed the fundamentals of safe investing in 2026. Now, let's dive deeper into the top investment strategies that can help you achieve stability and growth. The first strategy to consider is low-risk stocks, often referred to as defensive stocks. Defensive stocks are typically from sectors that remain stable even during economic downturns. Think utilities, healthcare, and consumer staples, industries that people rely on no matter the market conditions. These companies tend to offer steady dividends, which can can provide you with a reliable income stream. Another strategy is focusing on dividend-paying stocks. In 2026, companies with a strong dividend history are proving to be a safe bet. While stock prices might fluctuate, those dividends provide a cushion for your investment. This strategy is particularly effective when combined with a diversified portfolio. But let's not forget the power of bonds, another cornerstone of safe investing. Bonds are often considered a safer option because they offer fixed returns over a specified period. Government bonds, in particular, are among the safest investments you can make. In 2026, government-backed bonds remain a reliable way to protect your capital while earning interest. Of course, bond prices can fluctuate, but they're generally much less volatile than stocks. Another option to consider is corporate bonds from stable companies. These can offer higher returns than government bonds, but the key is to research the company's creditworthiness. For example, investing in bonds from established tech companies can yield steady returns. If you're looking for an alternative safe investment, real estate is worth exploring. Real estate tends to appreciate over time, offering both safety and potential growth. In 2026, demand for housing remains strong, especially in growing cities and suburban areas. Real estate investment trusts, REITs, are another option to consider if you don't want to directly manage property. REITs allow you to invest in real estate without the hassle of owning and maintaining physical property. What's great about real estate is that it's a tangible asset that holds intrinsic value, so in times of economic uncertainty, your property investment can serve as a safe haven. But let's switch gears a bit. What about alternative investments? Alternative investments are non-traditional assets like gold, art, or even cryptocurrencies. Among these, gold is often considered a safe haven in times of inflation and market volatility. In 2026, as inflation concerns rise, many investors are turning to gold as a way to preserve wealth. You can invest in gold directly through physical purchases or through gold-backed securities. Another alternative worth exploring is cryptocurrencies, specifically stablecoins. While many cryptocurrencies are highly volatile, stablecoins are pegged to assets like the US dollar. This makes them much less volatile, offering a safer option for those interested in digital assets. However, keep in mind that cryptocurrencies still carry some degree of risk due to regulatory uncertainty. A smart strategy is to limit your exposure to crypto and use it as a small part of your diversified portfolio. Now let's talk about one of the safest and most consistent investment strategies, index funds. Index funds track the performance of a specific market index like the S&P 500. Because they're diversified across multiple stocks, they help reduce risk while still providing growth potential. The beauty of index funds is that they're simple, low cost, and accessible to almost anyone. Over the long term, they've been proven to offer solid returns, making them a reliable choice for investors. In 2026, many experts recommend using index funds to gain exposure to the broader market. By holding a basket of diverse assets, index funds help you weather the ups and downs of the market. Another strategy to consider is investing in socially responsible funds, or ESG, environmental social governance investments. These funds focus on companies that align with your values and sustainability goals. In 2026, there's an increasing demand for ethical investing, and many companies are focusing on sustainable practices. ESG investments can offer steady returns while also contributing to a better future. But what about managing risk? How do we ensure that our investments stay safe while still growing? Risk management is a crucial part of investing safely, and it starts with setting clear goals. Are you investing for retirement? Are you looking to generate passive income? By setting your goals, you can determine the right asset allocation for your portfolio. A good rule of thumb is to allocate a portion of your portfolio to low-risk assets like bonds and dividend stocks. The remaining portion can be allocated to higher risk, higher return investments like growth stocks. Another key to managing risk is rebalancing your portfolio periodically as market conditions. Now that you have an understanding of the top investment strategies for 2026, it's time to discuss how to implement these strategies in your own portfolio. The key to successful investing is taking action, but doing so strategically. It all starts with assessing your current financial situation and setting clear goals. Ask yourself, what am I investing for? What What do I want to achieve in the next 5 to 10 years? Setting specific goals will help you determine your risk tolerance and guide your asset allocation. For example, if you're investing for retirement, you'll likely prioritize lower risk investments. If you're saving for a down payment on a house, you might be more willing to take on a moderate risk. The first step in implementing safe strategies is creating a well-diversified portfolio. Start by allocating a portion of your portfolio to low-risk assets like government bonds. These bonds provide a steady return and are less likely to fluctuate dramatically. Next, allocate another portion to dividend-paying stocks in stable sectors like healthcare or utilities. These stocks can provide you with regular income while maintaining a relatively low risk. Don't forget about the importance of real estate investments either, whether through direct property ownership or REITs. Real estate offers both safety and growth potential. When incorporating real estate into your portfolio, choose properties in areas with strong demand. Cities with growing populations or those undergoing revitalization tend to offer the best opportunities. Consider adding a mix of alternative investments like gold or stable coins to provide additional protection against inflation. But remember, don't go overboard. Alternative investments should only make up a small portion of your portfolio. Once you've created a diversified portfolio, the next step is risk management. Risk management is all about protecting your investments from unforeseen market movements. One of the easiest ways to manage risk is by rebalancing your portfolio regularly. As markets fluctuate, certain investments may grow faster than others, shifting your asset allocation. Rebalancing ensures that your portfolio stays in line with your goals and maintains the right balance of risk and reward. For example, if your stocks have performed well and now represent 70% of your portfolio, but your target allocation is 60%, it's time to sell a portion of your stocks and buy more bonds and dividend stocks. Regular rebalancing helps you avoid overexposure to any one asset class. Another important risk management tool is setting stop-loss orders. A stop-loss order automatically sells a stock if its price falls below a predetermined level. This can help you limit potential losses if the market takes a sudden downturn. It's important to set realistic stop-loss levels, though, not too tight as the market naturally fluctuates. Another strategy for safe investing is dollar cost averaging. This means consistently investing a fixed amount at regular intervals, regardless of market conditions. Dollar cost averaging helps smooth out market volatility and prevents you from trying to time the market. It's a long-term strategy that can reduce risk and help you accumulate wealth steadily over time. Now, let's take a closer look at implementing safe investments in the context of inflation. As we discussed earlier, inflation is a key factor affecting investment returns in 2026. To protect against inflation, consider investing in assets that typically outperform in inflationary environments. Real estate, for instance, tends to rise in value as inflation increases, providing both safety and growth. Stocks in sectors like energy, commodities, and technology are also well positioned to thrive during inflationary periods. You can also consider Treasury inflation-protected securities, or TIPS, which are bonds specifically designed to protect against inflation. TIPS adjust the principal value based on the rate of inflation, ensuring that your investment keeps pace with rising prices. Another way to combat inflation is by focusing on companies that can pass on higher costs to consumers. These companies, often in industries like consumer goods or healthcare, are more resilient to inflationary pressures. Now that you've implemented your investment strategy, it's time to monitor your portfolio's progress. Tracking your investments is essential for ensuring that you stay on track with your goals. One of the best ways to track your investments is by using online tools and platforms. Many brokers and financial institutions offer dashboards that allow you to track your portfolio's performance. These tools help you visualize your investments, making it easier to see how they're performing over time. But monitoring your investments isn't just about checking your account balance. It's about understanding how each asset class is performing and whether it aligns with your financial goals. Keep an eye on market trends and any news related to the sectors you've invested in. Pay attention to interest rates, inflation data, and geopolitical developments as they can affect your investments. Another important aspect of tracking your investments is reviewing your asset allocation regularly. Over time, your portfolio's performance may cause your asset allocation to shift. If your stocks perform exceptionally well, they might represent a larger portion of your portfolio than originally planned. On the other hand, if bonds or real estate aren't performing as expected, they might take up less of your portfolio. Regularly review and adjust your allocation to ensure that it still aligns with your risk tolerance and long-term goals. Let's take an example. example, if you started with 60% stocks, 30% bonds, and 10% real estate, but now your stocks have grown to 75%, it may be time to sell some stocks and reallocate funds. Rebalancing helps you maintain a balanced risk level and prevents overexposure to one asset class. This process can be done manually, but it's often easier to automate through your brokerage account. Many platforms allow you to set up automatic rebalancing so your portfolio stays aligned without constant monitoring. But how often should you rebalance? There's no hard and fast rule, but a good guideline is to check your portfolio at least once a year. If your portfolio has experienced significant changes in the market, or if your personal circumstance change, consider rebalancing more frequently. Another aspect of tracking your investments is monitoring your performance against a benchmark. A benchmark is a standard against which you can compare your portfolio's returns. For example, you can compare your stock investments to the performance of the S&P 500 index. If your portfolio is underperforming compared to the benchmark, it might indicate that adjustments are needed. However, don't obsess over short-term fluctuations. Investing is a long-term game, and one bad quarter a year doesn't mean your strategy is failing. When tracking your investments, it's important to focus on the bigger picture and the long-term growth trajectory. It's also helpful to regularly evaluate the performance of individual investments within your portfolio. Review the financial health of the companies you've invested in, particularly dividend stocks. Are they still paying consistent dividends? Are they growing their earnings? If a company's financials begin to deteriorate, it might be time to sell and invest in something more stable. Real estate is another asset class that requires ongoing monitoring. Keep track of the property market trends in the areas where you've invested. Are property values rising? Is there strong demand for rental properties? If a market is showing signs of stagnation or decline, it might be wise to adjust your real estate investments. In the case of REITs, monitor the performance of the properties they invest in. Pay attention to the financial reports and any news related to the management of the REITs. But it's not just about tracking your investments. It's also about adjusting your strategy when needed. As the market evolves and your financial situation changes, your strategy should evolve as well. For example, if you approach retirement and your risk tolerance decreases, you may want to shift more of your portfolio into low-risk, income-generating assets. On the flip side, if you're younger and looking to build wealth over time, you may want to allocate more towards stocks and growth-oriented investments. Adjusting your strategy based on life events is a smart way to safeguard your financial future. If you receive a bonus, an inheritance, or other lump sums of money, think about how to allocate these funds wisely to maintain a balanced portfolio. You might decide to pay down debt, boost your emergency fund, or invest more in real estate, but always ensure that you're staying within your overall investment strategy and risk tolerance. Tracking your investments also involves understanding the tax implications of your decisions. Capital gains taxes can eat into your returns, so it's essential to plan accordingly. Consider holding investments in tax-advantaged accounts like ISAs or pensions to minimize tax burdens. Congratulations, you made it this far. By now you have a solid understanding of how to invest safely in 2026. But the journey doesn't end here. Staying motivated and committed to your investment goals is key to success. As we've discussed, investing is a long-term game, and it can often feel slow. The market can be unpredictable, and there will be ups and downs along the way. So how do you stay committed when the market takes a dip or your investments don't seem to be moving? First and foremost, remember your why. Why are you investing? Is it for a comfortable retirement, a college fund for your kids? Keeping your goals front and center will remind you of the bigger picture. When you're feeling discouraged, it helps to take a step back and reflect on how far you've come. Look at the progress you've made in the financial habits you've built over time. Celebrating small milestones like hitting a savings goal or successfully rebalancing your portfolio can keep you motivated. It's also important to understand that investing isn't a sprint, it's a marathon. Compounding growth is powerful, and over time, even small contributions can lead to significant returns. One of the best ways to stay motivated is by continuously educating yourself. The more you learn about investing, the more confident you'll feel about your decisions. Stay updated on market trends, new investment strategies, and changes in the economy. When you're informed, you're better equipped to handle volatility and seize new opportunities. But education isn't just about reading financial books or articles. It's about learning from your own experiences. Take time to reflect on what's working in your portfolio and what might need adjusting. If a certain asset class or sector has consistently underperformed, consider adjusting your strategy. Similarly, when an investment is performing well, figure out what's driving that success and replicate it. Another key to staying motivated motivated is surrounding yourself with like-minded individuals. Join investment groups, online communities, or social networks where you can share insights and learn from others. Connecting with other investors can help you stay inspired and provide support during tough times. It's also helpful to work with a financial advisor or mentor who can offer guidance. A trusted advisor can help you stay on track with your goals and provide an objective perspective. Now let's talk about mindset. This is perhaps the most crucial element of successful investing. Your mindset will determine how you react to market fluctuations, economic changes, and personal challenges. In 2026, the financial landscape will continue to evolve, and a positive, resilient mindset will set you apart. When the market dips, don't panic. Understand that corrections are a natural part of investing. When things seem uncertain, remind yourself that the market has historically rebounded over time. Stay focused on the long term and avoid making emotional decisions that could jeopardize your future. To stay motivated, set both short-term and long-term goals. Short-term goals might include building your emergency fund or investing a set amount each month. Long-term goals might involve retirement planning or saving for a major life event. By breaking your larger objectives into smaller, more achievable steps, you make the journey less daunting. Revisit these goals regularly to track your progress and make adjustments as needed. It's also important to build a routine around your investments. Set aside time each month to review your portfolio, check for new opportunities, and stay informed. By creating a habit, investing becomes second nature and you're less likely to neglect it. But don't just focus on your investments. Also take time to focus on your overall financial well-being. A good financial routine includes budgeting, saving, and minimizing unnecessary debt. These habits will support your investment strategy and allow you to continue contributing to your portfolio. There will inevitably be times when you feel overwhelmed or doubt your strategy. During these moments, take a step back and reassess your goals. Have they shifted? Is there a new investment strategy that better aligns with your current needs? And remember that the road to financial security is rarely a straight line. It's filled with challenges, unexpected detours, and opportunities for growth. But by staying focused and committed to your long-term vision, you'll navigate those obstacles with confidence. And as you continue on this journey, remember that investing is a powerful tool for building wealth. By investing safely and smartly, you're not just protecting your money, you're setting yourself up for financial freedom. Keep learning, stay disciplined, and adapt to the changing landscape. Over time, you'll find that your portfolio grows, your confidence increases, and your financial goals are within reach. At the end of the day, investing safely in 2026 is our